Interest rates are often discussed as technical levers pulled by central banks, distant and abstract, like weather systems observed from afar. But for investors who have lived through multiple cycles, interest rates are not background noise. They are gravity. They quietly determine what floats, what sinks, and how hard everything hits the ground when conditions change. Financial celebrities who endure decades of booms and busts rarely talk about interest rates as predictions. They talk about them as environments. You do not argue with gravity, you design around it. When rates are low, leverage feels light. When rates rise, leverage gains weight. Entire portfolios feel different not because the assets changed, but because the force acting on them did. The most common mistake investors make is treating interest rates as a switch rather than a spectrum. They wait for hikes, they react to cuts, they read headlines and move money as if the change itself matters more than the level. Experienced investors learn the opposite. What matters is not direction alone, but where rates sit relative to history, inflation, and expectations. Context is everything. Interest rates influence portfolios first through valuation. When rates are low, future cash flows are discounted gently. Growth stories feel reasonable. Long-duration assets, those whose value depends on profits far in the future, appear attractive. Financial celebrities recognized this pattern long before it became popular language. They understood that low rates reward patience and imagination, sometimes excessively. When rates rise, the math reverses quietly but decisively. Future cash flows are discounted more harshly. Duration becomes risk. Assets once celebrated for growth are repriced for fragility. This is why rate increases often feel sudden and unfair to investors who anchored on yesterday's valuations. The assets did not fail. The environment changed. Bonds provide the most obvious lesson. Their prices move inversely to rates. But financial celebrities do not stop there. They understand that bonds teach a broader truth. Interest rates set the price of certainty. When rates are low, certainty is expensive. When rates are high, certainty becomes cheap. This shift alters the appeal of every asset class, not just fixed income. Equities respond in more complex ways. Rate changes affect companies unevenly. Businesses with heavy debt loads feel pressure quickly. Those with strong balance sheets feel less. Companies that rely on cheap capital to fund growth become vulnerable when financing costs rise. Those that generate cash internally gain relative strength. Interest rates, in this sense, act as a sorting mechanism. Another subtle channel is behavior. Low rates encourage risk-taking. Capital searches desperately for yield. Standards loosen. Narratives stretch. Financial celebrities observe that during prolonged low-rate environments, discipline erodes not because people become foolish, but because incentives reward optimism. When rates rise, the opposite occurs. Fear returns. Capital becomes selective. Discipline reasserts itself abruptly. Real estate illustrates this dynamic vividly. Low rates expand purchasing power. Prices rise. Leverage feels manageable. But higher rates compress affordability quickly. Demand softens. Valuations stall or reverse. Financial celebrities learn to separate long-term real estate value from short-term rate sensitivity. They focused on cash flow resilience rather than headline prices. Another critical effect of interest rates is on opportunity cost. When rates are near zero, doing nothing feels costly. Cash earns nothing. Investors feel pushed into action. When rates rise, patience is rewarded. Cash yields return. Waiting becomes a position again. Financial celebrities paid close attention to this psychological shift. It changed not only portfolios, but behavior. Interest rates also shape currency dynamics, which ripple into portfolios globally. Higher rates attract capital. Lower rates repel it. These flows affect asset prices, corporate earnings, and geopolitical balance. Financial celebrities with global exposure learn that interest rates are not just domestic tools, they are signals broadcast worldwide. Debt deserves special attention here. Interest rates determine whether debt is a tailwind or a trap. In low-rate environments, debt feels strategic. In high-rate environments, it becomes restrictive. Financial celebrities structure debt conservatively, understanding that refinancing risk is invisible until it suddenly dominates outcomes. Rate cycles reveal who planned for durability and who planned for continuation. Another overlooked impact lies in expectations. Markets move less on current rates than on what they believe comes next. If rate hikes are expected, assets may already reflect them. If cuts surprise, prices adjust violently. Financial celebrities learn to focus less on announcements and more on mismatches between expectation and reality. Surprise, not change, moves markets. Interest rates also interact deeply with inflation, often confusing investors. Rising rates can coexist with high inflation, low inflation, or falling inflation depending on context. Financial celebrities avoided simplistic interpretations. They examined real rates, interest rates adjusted for inflation, because real rates determine whether saving is rewarded or punished. This lens clarified much of the noise. Another lesson emerges around time horizon. Short-term investors fixate on rate decisions. Long-term investors focus on regimes. A single hike matters little. A decade of cheap or expensive capital reshapes entire economies. Financial celebrities align portfolios with regimes, not meetings. This perspective reduced emotional churn and improved consistency. Over time, the most seasoned investors stopped reacting to rates and started mapping their portfolios against them. Which assets benefit from rising rates? Which suffer? Which are neutral? This mapping was not static. It evolved as businesses changed, balance sheets adjusted, and policies shifted. Understanding interest rates became an ongoing practice, not a one-time lesson. Perhaps the most dangerous misunderstanding is believing interest rates are someone else's problem, that central banks handle them, that markets price them efficiently. Financial celebrities rejected this passivity. They treated interest rates as a primary variable, like oxygen in a room. You may not control it, but it determines how everything else behaves. And this is where the story begins to narrow. Because once interest rates are understood not as headlines to react to, but as forces to design around, portfolios stop being collections of assets and start becoming systems built for specific environments. It is at this point where rate awareness reshapes allocation, leverage, patience, and risk, that investors move from reacting to cycles to surviving them, as clarity replaces confusion and structure replaces impulse. Unfolding gradually as one learns to see interest rates not as enemies or saviors, but as constraints that quietly shape every return, every valuation, and every mistake, like the unseen pressure beneath the ocean surface that determines which vessels glide smoothly and which crack without warning. And this is where understanding interest rates becomes practical wisdom rather than abstract theory, because at this stage, financial celebrities stop asking what rates will do next and start asking how their portfolios behave if rates do anything at all. In the second half of this lesson, the most important shift is architectural. Financial celebrities redesign portfolios so interest rates are no longer a single point of failure. They accept that rates will rise, fall, stall, and surprise, often in ways that contradict forecasts. The solution is not prediction, it is robustness. The first adjustment happens with duration awareness. Every asset has a duration, whether labeled or not, the sensitivity of its value to changes in rates over time. Long duration assets promise value far in the future. Short duration assets return value sooner. Financial celebrities map their portfolios across durations deliberately. They avoid concentration in any single time horizon, knowing that rate changes punish imbalance. When rates rise, long duration fragility is exposed. When rates fall, short duration caution underperforms. Balance becomes insurance. Next comes a sober reassessment of leverage. Interest rates reveal the true cost of borrowed time. When money is cheap, leverage disguises risk. When money tightens, leverage demands precision. Financial celebrities do not swear off debt. They domesticate it. Fixed rates over floating, long maturities over short, ample coverage ratios over optimistic projections. Debt is structured to survive adversity, not just benefit from calm. Cash, too, is redefined. It is no longer a drag or a panic button. It becomes a strategic buffer whose value changes with rates. In low-rate regimes, cash is optionality. In high-rate regimes, cash is yield and patience combined. Financial celebrities adjust cash targets dynamically, not emotionally. They let rates determine the reward for waiting, and they wait when waiting is finally paid. Equities are filtered through a sharper lens as well. Interest rates expose business quality more clearly than almost any other variable. Companies that depend on constant refinancing weaken quickly. Companies that self-fund gain strength quietly. Pricing power matters more than growth stories. Balance sheets matter more than narratives. Financial celebrities tilt toward enterprises that can endure tighter capital without losing relevance. Real assets are handled with similar discipline. Not all real estate benefits from rising rates, and not all suffers. Cash flow matters more than price. Financing terms matter more than location glamour. Financial celebrities favor assets that remain useful regardless of credit conditions, housing people need, infrastructure society relies on, services that cannot be deferred. Rates may move prices, but necessity sustains value. Another crucial adaptation involves expectations. Financial celebrities spend less time reacting to rate announcements and more time examining what markets already believe. When consensus is crowded, surprises hurt more. When pessimism is widespread, relief moves prices faster. They position where expectations are fragile, not where news is loud. This reduces whiplash and regret. Interest rates also reshape behavior inside the investor. Rising rates slow the world. They reward patience, savings, and selectivity. Financial celebrities lean into this slowdown rather than fighting it. They do fewer things. They demand higher margins of safety. They let compounding work quietly instead of forcing activity. In high-rate environments, restraint becomes a competitive advantage. Over time, something subtle but powerful happens. Portfolios designed around rate awareness feel calmer, drawdowns are less shocking, opportunities feel clearer, the investor stops being surprised by outcomes and starts recognizing patterns. This calm is not confidence, it is alignment. And so the lesson resolves into a simple but demanding truth. Interest rates do not need to be predicted to be respected. They need to be designed for. When portfolios acknowledge gravity, they stop chasing flight and start ensuring lift. They survive tightening without panic and benefit from easing without arrogance. If this reflection resonated with you, pause and ask yourself one question. If interest rates stayed higher or lower than expected for the next 5 years, would your portfolio still function without forcing you into bad decisions? The answer reveals whether your strategy is reactive or resilient. Share that thought. And if you want to keep learning how seasoned investors build portfolios that endure changing environments, stay connected, subscribe, follow, and return. Because markets change their minds often, but gravity always wins.